Good morning, this is Ken at Tortoise Capital with a review of the weekend trading reports for June 23rd, 2018. Market remains in bullish quiet conditions. On an annual basis using NDX 260, we are in the higher end of neutral at 75 out of 100. Short term, we're on the boundary of oversold with a score of 20 out of 100 on NDX 10. Looking at the market mosaic, price relative to the 200 has pulled back to yellow bullish at 3.23%. Slope of the 50 went red neutral at 0.40. ADX remains an non-trending or a weekly trending 13.5. The risk index is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0. Current reading is at 1.017, so we are barely in risk on. When we compare that to the last 5,000 trading days and find the average and standard deviation, we can compute the risk Z, which is at 0.09, meaning it's at 0.09 standard deviations above the long-term average. You see here a 90-day histogram of that indicator. When we are above the zero line, that's favorable for swing trading. When it's declining, however, that gives us a caution that we are late in the summer and the fall. The summer would be rising, fall is failing towards the zero line, and that puts us at alert for potential one-day sudden volatility spikes. This can happen in either direction, but it's less likely to see follow-through when risk Z is in this condition. You can see the holdings still emphasizing the U.S., which is a good posture in the blended monthly rebalancing, with the next rebalancing due on or about 1 July. These are the leaders going into the close on Friday. In ETF 2, the theoretical exposure is at 40%. Just a quick thumb through here of the some blended monthly rebalancing portfolios. Again, you can see the U.S. dominating here with Latin America, Brazil, emerging markets still suffering. The same thing in the ETF 32. More than half of the symbols are on cash signals. Only the U.S. really looking any good at all. Still some interesting strength here in the consumer staples XLP, which has had a good week and month after an undistinguished 3 and 6 months. Dow 30, strength here in United Health, Visa, Nike, Microsoft, and Merck. Lots of weakness down here in 3M, Goldman, GE, and Travelers. I think I read that GE's coming out of the Dow 30, the last of the original Dow 30 industrials, talking about survivorship bias here. Nothing clearer than what happens in the case of the Dow 30 industrials. By the index, not the symbols. Sector spiders, about half to a third are on cash signals. You can see strength here in healthcare, retail, technology, and biotech. ETF Max, this looks at the top 500 or so of the most liquid ETFs and ranks them by their blended score. Interesting here in energy has made little rebounds. Healthcare looking good. Money coming out of software. There's a nice rebound in oil this week to get it back on track. Market health check. The vertical blue lines are 10, 20, 30, 40, and 50 days worth of look back. The horizontal red lines are support levels that have held. I'm marking two regions of support here based on the recent oscillations in the dragon. So those look like support regions to me. You see the 10-period regression line has definitely rolled over and sloping downward. Still finding support above this support level here, but it's had almost 10 days of marking time. And let's see if it can hold now at the Bollinger Band mean. The 30 period regression channel still pointing upwards. You can see the 200-day moving average acting as support here, but the market definitely in doldrums. That the MACD histogram still above the zero line, so that's favorable, but it has rolled over and come back into its little red river. Again, this is a market that's poised in a critical state with declining volatility, still finding some support at the 200, but certainly has been almost stationary for the last 3 months here. Needs to get above 284 really for us to have any indication of resumption of the Trump bump. ETF2, again, only the U.S. is above its 4-month moving average, so that puts us at 40 and 60 uninvested in cash in the theoretical allocation model. The U.S. at 66 is still better than the globals at 52. Inside the U.S., it's small caps, tech, mid caps, large caps. Two strongest are the U.S. tech and small cap sector. The two weakest remains Latin America and emerging markets. World market model, really, it's the U.S. and not much else that's in favor right now. ETF top 30. Again, using our little lookup table here. What I'm most interested are those that are green and white to exploit new strength with new leadership, and those make excellent intraday candidates. So things like natural gas, tech, and small cap value are certainly fall in that category. These are the 30 most liquid ETFs based on average 30-day dollar volume of trades. You can see the small caps starting to catch back up to the tech sector in terms of daily dollar volume. Financials still remain a robust sector. You see Brazil and energy have really had the play lately. Shifting to the daily report, DIA on a on an overreaction signal. You can see the 10-day max pain winners, the usual suspects. Many auto framers testing out better than 2-to-1. Handful of 551Ws as well as channelings and overreactions. So we have a target-rich environment. It's not unusual to see a lot of frog numbers now better than 3 on this compressing volatility that we have here. And a number of RSI2s in the single digits offer some potential. I'll be looking at GE. It's a max pain. Tests out well on the auto framer. It was a % winner on Friday, and that looks interesting to me. United Health, a 4.1 on the frog quality number, and has been dominating in different time frames here. So that's a way to look at momentum. In ETFs, a couple dojis and channelings, 1.5DD and financials. That has a 0 on the RSI2, so that looks very interesting for short-term bops. Technology with a RSI2 of 8, I find interesting. And again, lots of frog numbers to choose from. I think this oil exploration is certainly an area to look. Has been dominating across the board. In pinch and stretch, again, the most positive Z stretches, these are the furthest moves away from their Bollinger Band mean. That's either a continuation play or a reversal back to the Bollinger Band mean. These negative Z score stretches, these are the ones that are stretched to the downside, and again, the same idea. And those are the bottom feeders that I like to look at. Most expanded pinch boxes, these are the ones that have had extended moves that are directional for 30 days ish, and that tells you the how wide that pinch box is and how many z-scores. So Brazil has been so bad for so long that it's over 3 sigma in terms of how wide that river has been, or how wide that Bollinger Band mean has become. 4 good candidates in the super pinches: Apple, Devon Energy, Pfizer, and Verizon, all testing out well. That's one where all of the regression lines have come together to agree on a fair value, and the volatility has compressed the river to an extreme condition so that it's ready for a breakout in either direction. That these make excellent short-term trades as well, and they can usually grow into swing trades. And you can see the just sheer lack of movement in the indexes here the last 30 days. Stabilizing. This just means the 200-day moving average is catching up, while this has been moving sideways. The 200 has been marching up closer and closer. So we're a full standard deviation below average compared to the last 200 days. Last 180 days, excuse me. Volatility is really compressed, ready for a sharp spike by either of these measures. Z-scores of the regression line slopes. The 90 has come back to the long-term average. The 10 has pulled way back. The 30 has pulled back and found some support in here in the inside the river. So again, this is postured for a nice base to move from. So if you say leg 1, leg 2, and leg 3, it's now postured for leg 4. Has to really get above 284 and then 286 to make the next leg up look realistic. And that's everything I want to cover from the weekend report. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry. This is a market that is favoring stock pickers, risk management, shorter term time horizons, and a U.S. focus. Take a look at energy and small caps for your guide.